Welcome. This is not clickbait. I'm going to show you my plan to turn $15,000 into $500 a week using Tesla. In this video, we're going to talk about options. We're going to talk about my strategy to do this, and we're going to talk about how this might apply to other stocks as well. The strategy that we're going to be using works really good on volatile stocks, but not all volatile stocks. There are certain situations that you're going to want to look for. I'm going to show you this, not because I want you to go out and do the same trade I'm doing and boost the stock price. I don't care about that. I don't know if Tesla is going to go up or down from where we're at right now. This is about education. You guys know, if you've watched any of my videos on this channel, you know I'm a big fan of options and how we can use them to maximize our cash flow. And that's my specialty, cash flow. So if you appreciate the content that I'm bringing you day in and day out, hit that like button. Subscribe to the channel if you want to follow along, because we will be tracking this trade week to week, keeping you updated on it. This is the spreadsheet where we're going to be keeping track of this trade and all of the things that we do with it to make money. I have this in the same spreadsheet where I'm currently tracking our trades on NVIDIA, GME, and Bros. You can have access to this spreadsheet if you are a channel member, and you can become a channel member for as little as $1 a month. It's not very expensive, but that gives you access to our Discord, where you can also ask me questions. So feel free to join if you think it might be helpful. Now, one thing to keep in mind with this, I'm giving you ideas. I'm showing you what I'm doing. This is not specific financial advice for what you should do. I don't know how doing something like this fits in with the rest of your portfolio, what type of risk it represents in relation to everything else you've got going on. This is just going to give you ideas so that you can take them and see maybe there's a way that it can help you when you're figuring out how to work with your finances. First of all, Tesla. If you've been paying attention to this at all, you know that over the last 3 months, it's dropped 40% in value. If you had started the strategy that I'm about to show you way up at the peak, there's no way to avoid losing money, and it may not work out for you. So you got to be careful with this stuff. We let it run all the way down. It looks like a fairly safe place to buy. You can see there's been a lot of action in this area. With the strategy that we're going to employ, it could still keep coming down. I don't want it to, but it could. It's not going to keep us from making the weekly income that we're shooting for with this strategy. And if it turns around and pops back up, great. We're actually hoping for that, and we're going to be adjusting accordingly. So this is the play that we did. I bought to open a leaps option shortly before close on the market today. Today's Friday. We paid $15,800. I immediately sold a covered call at the $262.50. Now, Tesla was at like $261. It was right below the strike price where we sold the option. So we effectively sold an at the money call option expiring next week. Now, the leaps we bought doesn't expire until June 17th, 2027. We've got 119 weeks between now and then to start making some money. Now, the premium that we got, $1,000. If I wanted to, if I thought Tesla was just going to go down, I could just sell it and make $1,000 this week. But I don't know what Tesla's going to do. We always want to account for a directional movement either way. Tesla is a very, very volatile stock. It can move violently in either direction. And because I'm buying this leaps, we're not profitable on this. Our break even is the 140 strike price plus $158 per share. So we're not profitable unless Tesla is over 298 if we were to exercise that. And we're not planning to exercise that, but if the person I sell my call to exercises that call, I'm going to have to exercise my leaps put in order to pay for it. That's not going to be pretty if it happens way too early in this trade before Tesla's gone up or we've collected enough premium to offset our cost. So we sell the at the money. That gives me $1,000 to work with. We're assuming I own the shares, and I effectively do at the 140 strike price. My delta is up close to 90 on this, which is the equivalent of owning about 90 shares. So we effectively own the shares. When I sell a covered call, when I choose my first strike price, that gives me my budget for the week. My budget is $1,000, $1,018. With that $1,018, this is what we call the short call or covered call. We're going to purchase a debit spread with that premium. So I'm taking this $1,000 and I'm buying a 265 strike call and I'm selling a 270 strike call. This is a debit spread. The cost is the difference between these two right here. $216 is the cost for that debit spread. I'm going to show you how all these work together when we look at the brokerage firm, and I'm going to show you the option strikes. Just know that this costs $216. My net, when we include the premium, I'm still at $802 that I have for a budget. Well, my biggest concern is Tesla going up. If Tesla shoots up really fast, I don't have time to collect enough premium for enough weeks to make this profitable. That's the challenge here with a volatile stock. If it goes down really fast, we could deal with it. But if it goes up really fast, that's when it gets challenging. So we got to guard against it going up too fast. So our budget is now $802. We sell another spread. Now I'm doing this a little farther out of the money. The 272 strike, we're going to buy that. And we're going to sell the 277 strike. The cost of that one, $162. The max gain on this spread, if Tesla goes up to 270, I get $500. If it costs us $216, that means I have a gain of $284 on that spread. If it continues to go up, I have a cost of $162 on this 5-point spread. Max gain is $500. That's a profit of $338. If Tesla goes up this far, this is going up in value. So is this. Ultimately, what we do with that, these strike prices right here represent a potential loss of $2.50. I can think of these two like a credit spread. I effectively earned $115 to put on this credit spread, and the max loss is $250, the difference between these two strike prices. That gives me another $5 of room that Tesla can move up before it gets to the next credit spread. This effectively becomes my credit spread. My credit spread ending at the 272 strike. And then this last one that I sold to open, this ends up being my covered call that I roll to the next week. This goes up in value. We lose a little bit of money here. We lose a little bit of money here, but this went up a lot. And this, we're able to roll it for a credit. We could potentially roll it out and up, but we roll it and then we do the same thing, guarding against the upside. That's the plan. Now for this week, the total between these is $640 net credit. I got $1,018 for selling this call. I spent $378 of that $1,018, leaving me with $640. So in my thumbnail, when I said $500 per week, we're making more than that this week. Now Tesla right now is in a very volatile place. Options are at a premium. It's not always going to be $1,000 for selling at the money, but Tesla's usually pretty good. Tesla and Nvidia are like the #1 option sellers week in and week out. There's a lot of volatility and there's a lot of money to be made selling these options. The challenge is, how do you do it safely? It's very difficult to do it safely, especially if, like I said earlier, you get in at the top and you got to ride it way, 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 way down. That's challenging. Hopefully we got in near the bottom. Even if we didn't, it's okay. We're going to make significant premium. If we can make $500 a week or $600 a week, even if I have to sell it every week because Tesla just goes sideways or down, but stays somewhere around this 140 strike or higher, we're going to be able to easily recover. I mean, at $600 per week, we recover this $15,000 cost in 6 months, and then it's all profit from there. I've got over 2 years. I have over 800 days. We've got 119 weeks that we can sell these things. That's over $60,000 if we can get $500 per week. Not too bad. Think of it like real estate. I just bought a $15,000 house and I'm going to rent it out each week, hoping to get about $500. Except I don't have to pay property taxes. I don't have to deal with maintenance. I don't have to deal with tenants. That's a pretty good deal. Now that $640 represents a 4% return in 1 week on that $15,800. We're just going to track each week how much we make. We'll show that here so that we can just see the different premiums, see if it goes up or down. And then we have the totals right here. So this is where we're at when we take premium received minus where we started. That's right there. This is the value of all the calls we buy. This is the value of all the calls we sold. And then that obviously gives us our net there. Make sense? If you got any questions, leave them in the comment section. Let's see what this looks like at the brokerage. All right, here's Tesla way down here. is the 832 days till expiration, June 17th, 2027 expiration. And there's the call that we bought. We're at the 140 strike price. Now, why did I go all the way out to there? I didn't have to go all the way out to there. If we went 1 year earlier, 468 days out instead of 832, to buy the 140 strike, it only saves me about $1,400. Now, if I had to worry about that from a budgeting standpoint, I wouldn't mind doing it right here and going 1 year out. But for $1,400, it buys me 52 plus more weeks. Actually, it was like 400 and some odd days. So figure 60 or 70 extra weeks that I could potentially make $500 a week. And it was only $1,400. So if I have the cash, I like the longer position better. If I expect to get out of this very quickly, I might as well go with the shorter time frame. It increases my overall return on investment. If I spend less money, but I get the same amount of money, because the calls I'm going to sell, they're going to be the same price, regardless of what I paid over here. The difference is I bought myself more time because I don't know what this thing's going to do. I want this to be a profitable trade in the long run, and it might end up taking some work. And the more time that I have, the less I have to worry about that. Oh, here you can see this is the delta. We're at the 0.87 delta. This reacts like 87 shares when it comes to the price movement. Our theta is almost non-existent. The option loses value at $3.70 a day. That's not very quick at all. Contrast that with what we're working with a week out. The at the money call option that we sold, the theta is $76. It's losing value at $76 per day. That's if Tesla trades straight sideways. This is how we end up making good money on these. With the difference in the theta there, we're harvesting that time value of the price of options that are expiring very soon. The delta on this one doesn't move near as quickly as the delta on the one that we own. When you're at the money, it's close to 50. So when Tesla drops in value, this is going to lose value based on the delta slower than the leaps will lose value. So the worst thing that can happen in these situations is we get a very fast movement up or down. When you get fast movement up or down, this loses less money on the downside than what I'm going to lose on the leaps. On the upside, as the price moves up, so does the delta. The delta changes every time the price goes up. So this quickly accelerates. And pretty soon we find ourselves in a situation that this has gained in value quicker than our leaps has gained in value. And since we sold this one, that means we're losing money. Now, the reason this changes is because of gamma. Gamma is another Greek that if you're trading options, you should have an idea about. I have an options trading course. It's free. We're just putting it together. There's options 101 and options 102. I'm going to link to those right up here. Check those out. Options 101 goes over the basics. Options 102, we get into where does the option derive its value from? And that has to do with the Greeks. So check that out if you're unsure what I'm talking about. But that's basically the risk, is that these end up moving too quickly when we have fast price movements. That's why we do this. That's why we did the spreads. When I sold these spreads, we sold it like that. Bought, sold. It's a $5 wide. You can see the cost, $217. Potential win, $500. But it doesn't matter if we look at this as a debit spread here or a credit spread here. This represents a loss of $250. It's $250 between these strike prices. The biggest risk that this trade represents, there's two of them. One is a big move down, but two is a big move up, way down here. If I just sold this and then one of these spreads, if Tesla only moves up to here, great, I'm in good shape. I lose a little bit on this, but we gained some on this. Overall, we're profitable, and it's not too far away from us that we can't still roll our original call. But the challenge is if Tesla keeps going. This represents the expected move for Tesla. Tesla's expected to get way up here in 1 week. Now, if it does move up pretty quickly, I'm probably going to add another spread out here because I don't want it to get up too far. If I didn't have this one, and we only had this one and this one, my max gain on these two is $500 or about $300 more than what I paid for it. So let's say Tesla moves way down here. This goes up to $2,000. I just lost $1,000 between what I sold this for and and what it's now worth. I lose $1,000 and I only gained $300 from these two. And Tesla might be so far down here that I can't roll this for a profit the next week. That's the big risk that we face. So we want to have most of the expected move covered in order to make this work. That's why I took this budget and I purchased some debit spreads below that. Hopefully that makes sense to you. I'm good with options, so I can really understand this pretty easily. I don't know if I'm expressing it properly so that you can understand it if you're not also really good at options. Although, if you're not really good at options, you probably shouldn't be engaging in this yet. Make sure that you do your due diligence and learn about this stuff so that you can avoid the risks like I just talked about. You don't want to get in trouble selling this one, buying one spread because you saw me do it, and then suddenly Tesla shoots up $50 in a week, which it's done before, and you find yourself losing a whole bunch of money. That is a very real possibility. That could actually happen. Now, if we're paying attention to this and Tesla moves up and it looks like it's going to keep going, I can continue to buy spreads that give me the ability to continue rolling up, or I can just get out of the trade. Because if Tesla ends up here, even if it moves quickly, I should be able to get out of that trade for a profit. And then we just reassess. We just start over. But we don't want to get in trouble. You got to understand what will get you in trouble so that you can avoid it. Let's look at some other examples. This is Costco. Let's say you own 100 shares of Costco, because you don't have to do this with a leap. Costco is very expensive. It's almost $1,000 per share. So if you own 100 shares, that's $100,000. We're going to think of that like a $100,000 house. What can we get if we rent it out? If we sell an at-the-money call option, that's almost $1,500. You could probably get $1,500 for that. The expected movement is way up here. So we could say buy that one, sell that one, and we have coverage for the expected move. Of that $1,500, we had to spend $700 to buy this spread. We're still getting $800 in credit. $100,000 house, $800 for the week. That's a pretty good deal. This strategy tends to work good on expensive stocks. Costco does not have that high of volatility right now. It's a little bit elevated because they had earnings, but that was this week. This is the week after earnings. Costco, yeah, it's probably normally somewhere in the 30% range. Tesla, the IV, the volatility on Tesla, 82%. That's why even though Tesla's only $200, $260, we can get a lot of premium for this. Nvidia, a week out, is at 69%. But Nvidia's share prices are not very expensive. So it's a little bit harder to do this with Nvidia. If we sold at the money, if I was to buy and then go the expected move, okay, I still get $180 credit. That's still pretty good. But I think the biggest risk on Nvidia right now is that we're afraid it's going to keep going down. But this is one good way to manage the upside moves, because Nvidia can move like crazy in 1 week. And it can be a challenge to keep up with it if we're selling covered calls. Now, if I thought it was going to move the other direction, I could sell the call here and buy a put spread and still get 171 in credit. We did something similar this week on Nvidia. I'm going to have that in a separate video, so be sure to look for that. We do have a leaps on Nvidia that we're trading and making some income with, and we're going to track it just like we're tracking this Tesla one. I'll probably combine the videos in the future when I don't have quite so much to talk about. Now, where doesn't this work? Cheap, volatile stocks like GME. GME is at $24 per share. GME is very volatile, although right now the expected move in a week is not very much. But if you pay attention to GME, it can easily move that much in a day. So if you own the shares or you own a leaps on GME, you're not going to want to sell the 70 strike or the 24 strike, which is at the money, for $70. That doesn't give us very much to work with. I can buy and sell here. I can get the move up to $26 or $27 and still collect $34 in credit. All right, that's not so bad. But GME is one of those ones that can shoot right through the strike price before you know it. And you remember when I talked about with Tesla, if it shoots way up there and we didn't get out of this immediately, we get run over. We can't roll these, and we didn't make enough money to cover what that is going to cost. So it can be a challenge to do that with these types of stocks. You just don't get a whole lot of credit when it comes to doing the spreads. IV on GME right now, 73. sometimes that gets up quite a bit higher. And the higher that gets at the lower strike prices, you just can't make any money selling premium. Like you try and sell, this is a risk of $100 and it's pretty close to the money and you only get $16 for that. I don't want to put that on because I don't make that much. If the stock price moves up through that, it's a different story when it comes to some stocks like this. So some things to be aware of, a little bit different strategy than we've talked about in the past. Certainly it's nice to know how we can do this with a very volatile stock that won't let it run through our strike price and really get us buried, but also allows us to be fairly aggressive when it comes to collecting premium. Let's look at one more thing here with Tesla. If I wanted to just sell out here at the 277.50, I could do that. And I get $450 and it leaves me all kinds of room for Tesla to go up without running through me, but doesn't protect me on the downside as much. I got to collect $200 more premium by doing it this way. So this is a little bit of a hedge to the downside. I'm not strictly leaving room to the upside. I want to be aggressive. I want to be able to collect some good money. And I want to be protected if Tesla goes down. If Tesla goes down, we could find ourselves in a situation where we close out some of these, save on that money. In this situation, I have 3 call options that are going to lose money faster than these 2 will lose money. Now, if Tesla goes up, these 3 are going to gain value faster than my 2 are going to gain value. But remember, I also have my shares or I have my leaps. So we're okay with that. I collected my $640 for the week. We're happy. Tesla moves up and my leaps gets a little more valuable. Even if I have to spend a little bit of money to roll this out, this gets me in a better position by $15 per share. I'm okay with that. Puts us in a really good position. So hopefully that's helpful for you guys. Questions or comments, leave them in the comment section below. We'll see you next time. The next 20 seconds determine your future. Subscribe, meet with me, or continue educating yourself with these videos right over here. I appreciate you. Now go maximize your cash flow.